Ayushi Verma from Investor Learn Academy, and I welcome you all to this channel. In the last video, we understood the concept of valuation ratios. Today we will look into another category of ratio, which is the operating ratios. The operating ratio is the measure of efficiency that is used by the management to determine day-to-day operational performance of the company. This ratio comprises operating expenses, also known as OPEX, to net sales. These ratios are also called as activity ratios, management ratios, and the asset management ratios. The operating ratio metric assesses how effective an organization is at maintaining a lower cost of operations while generating a certain level of sales and revenue. A smaller ratio indicates the organization is generating more revenue as compared to the total expenditure. The only limitation of this ratio is that it does not include the company's debt amount, and it can be calculated with this following formula. Operating cost is equal to the cost of goods sold plus operating expenses. Non-operating expenses such as interest charges, taxes, etc. are excluded from the computation. Let's take an example. The following data is taken from Royal IT Solutions Limited, whereas we can see the net sales of 5 lakhs rupees, cost of goods sold 2.5 lakhs, administrative expenses 35,000, selling expenses 15,000, and interest charges 10,000. Now let's compute the operating ratio for this company. The operating ratio, profit ratio, is coming out to be 60%. It means 60% of the sales revenue would be used to cover cost of goods sold and other operating expenses of this company. The ratio should be compared with the company's past year's ratio and also with the ratio of other companies in the same industry. An increase in the ratio should be investigated and brought to attention of management as soon as possible. The operating ratio varies from industry to industry. Some of the popular operating ratios are fixed assets turnover ratio, working capital turnover ratio, total assets turnover ratio, inventory turnover ratio, and account receivable turnover ratio. Now let's understand these ratios in detail. The first is the fixed assets turnover ratio. It tells us how effectively the company uses its plant and equipments. The fixed asset turnover is an efficiency ratio that indicates how well or efficiently a business uses fixed assets to generate sales. Fixed assets include the property, plant, and equipment. Higher the ratio, it means the company is effectively and efficiently managing its fixed assets. A high turnover indicates that assets are being utilized efficiently and large amount of sales are generated by using a small amount of assets. The other reason of high turnover could be that the company has sold off its equipment and started to outsource its operation. A low turnover, on the other hand, indicates the company isn't using its assets to their fullest extent. This could be due to various reasons, like they might be producing products that no one wants to buy, or they might have overestimated the demand for their product and overinvested in machines to produce the products, or it might also be low because of some of the manufacturing problems in the company. Now the second ratio is the working capital turnover ratio. The working capital ratio, also called the current ratio, is a liquidity ratio that measures the firm's ability to pay off its current liabilities with current assets. The working capital ratio is important to creditors because it shows the liquidity of the company. This refers to the capital required by the firm to run its day-to-day operations. To run the day-to-day operations, the company needs to have certain type of assets like inventories, receivables, cash, etc. And these assets can be converted into cash much quicker than the fixed assets. The faster the company can convert these assets into cash, the more likely the company will have the cash in time to pay its debt. The following formula can be taken to calculate this ratio. If the working capital is a positive number, it implies that the company has working capital surplus and can easily manage its day-to-day operations. However, if the working capital is negative, it means that the company has the working capital deficit, and if it is deficit, they seek a working capital loan from their bankers. The working capital turnover ratio is also referred to as the net sales to working capital, and that indicates how much revenue the company generates for every unit of working capital. Suppose the ratio is 4, then it indicates that the company generates rupee 4 in revenue for every 1 rupee of working capital. It is always better to have higher number of this ratio. Also, it is always good to compare this ratio with its peers, competitors within the same industry, and also with the company's past ratios. The formula to calculate the working capital turnover ratio is as follows. Now the third is the total assets turnover ratio. It indicates the company's capability to generate revenues with a given amount of assets, both the fixed assets as well as the current assets. In other words, this ratio shows how efficiently a company can use its assets to generate sales. A higher total asset turnover ratio compared to its historical data and competitor data means the company is using its assets well to generate more sales. And the following formula can be used for calculating this ratio. Higher asset turnover ratios means the company is using its assets more efficiently. Lower ratios means that the company isn't using it efficiently and most likely have some management or production problems. For example, a ratio of 1 means that the net sales of the company equals the average total assets for the year. In other words, the company is generating rupee 1 of sales for every rupee invested in the assets. Now the fourth ratio is the inventory turnover ratio. Inventory refers to the finished goods that a company maintains with an expectation of selling the finished good to the prospective clients. It measures how many times a company sold its total average inventory amount during the year. This ratio is important because total turnover depends on two main components of performance. The first component is the stock purchasing. If the larger amount of inventory are purchased during the year, the company will have to sell greater amount of inventory to improve its turnover. If the company can't sell these greater amount of inventory, it will incur storage costs and other holding costs. The second component is sales. Sales have to match inventory purchase, otherwise the inventory will not turn effectively. This measurement also shows investors how liquid a company's inventory is. Inventory is one of the biggest assets on its balance sheet. If this inventory can't be sold, it is worthless to the company. This measurement shows how easily a company can turn its inventory into cash. Creditors are more interested in this because inventory is often put up as the collateral for loans. So bank wants to know that this inventory will be easy to sell or not. Now the fifth ratio is the accounts receivable turnover ratio. The receivable turnover ratio indicates how many times in a given period the company receives money or cash from its debtors or customers. A high number indicates that the company collects cash more frequently. For example, a ratio of 2 means that the company collected its average receivables twice during the year. And the formula to calculate the same is as follows. So in this video, we learned about the operating ratios. We'll meet you next time. Till then, be safe and happy learning.